The dinar didn't move today, the plumbing did, and the street just exposed a stress the official rate can't hide. Everyone's staring at the number the government prints, but the real signal is in the gap nobody wants to talk about, because once you see it, you can't unsee it. And later in this video, I'm going to give you the few levels that matter, the two scenarios that split the next couple of weeks, and the exact checklist you can use to tell whether this spread is about to compress or about to bite harder. Because if this one mechanism stays jammed, the math changes. Let's get clean on what parallel market spread actually means, because people hear it and instantly go emotional, like it's either the end of the world or a nothing burger. It's neither. It's a pressure gauge. When an official rate stays stable but the street rate jumps, the gap is not just a difference. It's a live, real-time tax on trade, inventory, and confidence. It's the price of access. It's the price of timing. It's the price of settlement certainty. And that's where the real pressure starts. Right now, the simplest way to picture it is this. The official number is the posted menu price. The parallel market is what you pay when the restaurant is out of half the items and you need the meal tonight. You can argue the menu all day, but your stomach doesn't care. Commerce doesn't care. If an importer needs dollars this week to clear goods, pay duties, and keep shelves stocked, they pay what clears. The spread is the market screaming, access is tight, but that's not the part that matters. The part that matters is why access suddenly got tight right now. Reportedly, in just a short window, the street rate moved from around 138,000 dinars per $100 to roughly 148 kilos 500 per $100, while the official side stayed near the 132,000 per $100 area. Translate that into what your brain actually understands. The premium didn't drift, it widened fast. Speed is information. A slow premium can be a background condition. A fast premium is usually a bottleneck, a sudden burst of forced demand, or a liquidity hole where nobody wants to be the seller. And that's the clue most people miss because they focus on the headline and ignore the mechanism. Now, here's us why you should care even if you never touch IQD, and you're sitting there thinking, cool story, I trade metals. Just cease. This is exactly the kind of setup that commodities people understand instinctively. The posted price is not the price when deliverability becomes the problem. When the physical constraint shows up, the paper reference stops being the whole story. You get premiums, you get spreads, you get a market that looks calm on the surface and stressed underneath. And once the stress is underneath, it leaks out through inflation, through inventory behavior, and through confidence. Because what a widening currency premium really does is it drags the cost of imports upward, it forces merchants to reprice faster than consumers can process, and it rewards hoarding behavior. And that's when psychology takes over. But we're not going to get hypnotized by psychology yet. We're going to pin the why now to something concrete, because the timing is the tell. This didn't happen in a vacuum. It flared right as the calendar flipped and a new system started biting in real time. That's the calendar catalyst. Year-turn transitions are when rules get enforced, paperwork changes go live, budgets reset, and liquidity gets weird. You see it in equities around quarter end. You see it in commodities around delivery windows. You see it in FX whenever a policy change hits the settlement chain. Thin liquidity plus operational change is a recipe for gaps. And a spread widening is basically a gap that won't close because the arbitrage is blocked. That's the key. And the next detail is what flips the whole setup. Here is the hidden detail that reframes this entire move. Upfront payment requirements at customs can turn trade finance into immediate cash dollar demand. Not eventual demand. Immediate. If a system forces duties and fees to be paid before goods clear, it changes the timing of money. It pulls demand forward. And when demand gets pulled forward in a market with friction, compliance checks, limited access channels, settlement delays, you get a scramble. And when you get a scramble, you get a premium. You don't need a grand story. You just need a timing mismatch. Think about the importer's reality for a second. They're sitting on goods that need to move. Every day stuck at a port is cost. Storage costs, spoilage risk, missed sales, penalties. Their customer is waiting, or their retailer is waiting, or their supply chain is waiting. If a new customs process requires prepayment, the importer needs dinars converted to dollars on a deadline. They don't care about your macro thesis. They care about clearing their goods. If the official channel can't deliver dollars quickly enough, or if approvals are slow, or if documentation is rejected, or if banks are cautious, then the importer buys in the parallel market. They are forced buyers. And forced buying is how prices jump. That's not conspiracy, that's market structure. Now layer in the concept that a lot of people want to admit. Not all dollars are equal. An official transfer dollar and a street cash dollar trade like two different assets when settlement risk is high. In normal, frictionless markets, you'd arbitrage the difference away instantly. You'd buy cheap dollars in one place, sell in another, and the spread would collapse. But when compliance, documentation, and access rules stop that clean arbitrage, the spread becomes sticky. It becomes a wedge. And a wedge in FX is basically a stress fracture that shows you where the system is taking load. But that's not the only proof. Let's stack it. Because finance audiences don't trust one argument, and you shouldn't. First proof point is the street symptom itself. When citizens and small businesses rush into dollars, the parallel market stops being a price and becomes a vote. In a lot of economies, the dollar is not a trade instrument, it's a psychological instrument. People use it as a memory. They remember past episodes of instability. They remember moments when official assurances didn't match lived experience. So when they see a spread widening, they don't wait for a press conference. They hedge, they buy just in case. And that just in case, demand is incredibly powerful because it's not price sensitive in the short run. It's fear sensitive, and that's where volatility gets weaponized. Second proof point, timing of cash flows. Salary cycles matter more than people want to admit. If payroll timing gets delayed, or if people are uncertain about when money hits accounts, they front-run their needs. They stock essentials. They buy dollars. That compresses demand into fewer sessions. It's like taking a month of normal buying and cramming it into a week. Markets don't like compressed demand. Prices gap, spreads widen, liquidity thins, and then the media shows the spike and acts surprised. But the mechanics were already there. Third proof point, the government's own behavior tells you they care about the gap. If the parallel premium didn't matter, you wouldn't see repeated efforts to force transactions into official channels, to restrict unlicensed trading, to tighten compliance, to nudge de-dollarization, and to shape how imports are financed. The point of those measures, regardless of how you feel about them, is to compress the spread. When policymakers spend energy on compression, it's because they understand the spread is a credibility meter, and credibility is a currency asset. The minute credibility cracks, the cost of defending the official anchor goes up. Fourth proof point, reserves are high can coexist with a street squeeze. This is the stock versus flow trap that fools a lot of smart people. A country can have substantial reserves on paper while the street still experiences a shortage of accessible dollars, because what matters in the street is distribution and timing. Reserves are a warehouse. The parallel market is the delivery route. If the delivery route is congested, the warehouse being full doesn't stop someone from paying extra for same-day shipping. That's literally what a premium is. And when people argue, but reserves, they're debating the wrong variable. The spread is not purely about quantity, it's about convertibility under constraints. Fifth proof point, the official rate being anchored to the budget is not just a number, it's a promise. If the budget assumes an official rate around 300 dinars per dollar, that's a deliberate anchor for planning, pricing, and government spending. But an anchor has a cost in turbulent water. If the parallel market drifts too far, you create a widening gap between official accounting and street reality. That gap breeds distortions. Importers price to street costs, consumers earn in dinars, and the difference becomes social stress. That's why policymakers treat spread widening like a fire. They don't want the smoke. And that's where the market structure gets fascinating. Because what you're watching is essentially a spread market. You've got an official reference and a parallel clearing rate. The premium is the spread. And spreads widen when arbitrage is impaired. In commodities, you'd call it a basis blowout. In rates, you'd call it a liquidity premium. In FX under constraints, it's a parallel premium. Same logic. When the mechanism that normally keeps prices aligned is clogged, the spread starts doing the work. And spreads, when they start screaming, usually point to one of three things: a surge in urgent demand, a sudden reduction in supply, or an increase in perceived risk of settlement. Here, you can see all three trying to happen at once. But the next detail is what makes it actionable. Actionable doesn't mean go trade it. It means you can tell whether the system is stabilizing or destabilizing. And the easiest way to do that is to stop watching speeches and start watching constraints. Constraints are measurable. Even if you don't have perfect data, you can watch the symptoms. Are merchants repricing daily or weekly? Are importers complaining about delays? Are exchange shops quoting wider bid-ask spreads? Are premiums for physical goods rising? Are people talking about availability more than price? These are the on-the-ground indicators that a premium is moving from a financial phenomenon to an economic one. And when that transition happens, the next phase tends to be sharper. But that's not the only angle. Let's zoom out globally for a second to keep ourselves honest. Parallel premiums are not unique. Look around the region and beyond. Whenever you have an official peg or managed rate and then you add political friction, compliance constraints, or confidence shock, you often get a second market. That second market can be small and quiet for years, then suddenly loud for weeks. In other Dinar economies, like Libya, you've seen periods where an official rate exists, while a parallel rate tells you what the economy is actually paying at the margin, especially during political instability. The lesson isn't same country, same outcome. The lesson is the mechanism. When convertibility is constrained, the street becomes a price discovery engine. It doesn't care what the official board says, it cares what clears. And that's the part that flips the whole setup, because price discovery under constraint tends to be reflexive. Reflexive means feedback loops, and a widening spread creates feedback loops fast. Merchants see the spread widen, and they don't wait. They front run. They raise prices because they assume replacement costs are higher. Households see prices rising, and they hedge by buying dollars or stockpiling goods. That increases demand for dollars and goods, which pushes the parallel rate and inflation expectations higher, which then justifies the merchant's next repricing. This is not mass hysteria. It's rational behavior under uncertainty, and rational behavior under uncertainty still creates volatility. That's why you can have a market that should work stabilize but doesn't T, because expectations move faster than policy execution. And that's where the real pressure starts. Now, let's talk about the mainstream mistake. The mainstream watches the official rate and says, stable. Then they watch the parallel rate and say, speculators. That's lazy. Sometimes speculation exists. Sure, but in most cases, the dominant driver of a sudden premium jump is forced buying from the real economy, plus friction in the official channel. And you can test that hypothesis. If it's mostly speculative, the move tends to mean revert hard once the initial shock fades, because speculators take profit and liquidity returns. If it's forced demand and structural friction, the premium stays elevated and becomes choppy, because every dip gets bought by someone who actually needs dollars, not someone who wants to flip a chart. And that distinction matters this week because it tells you what to expect next. So here's the roadmap lens you should use for the next 1 to 2 weeks, and we'll keep it brutally simple. 2 scenarios. Scenario 1 is the controlled pullback and retest. Scenario 2 is the continuation squeeze with gap risk. You don't have to predict which one happens. You have to watch which one starts to confirm itself. Scenario 1, the system adapts. Importers learn the new process. Banks process transactions faster. The paperwork rejection rate drops. The immediate upfront payment shock fades. Salary and cash flow timing normalizes. In that scenario, the parallel rate cools, not necessarily back to the official number, but back toward a more contained premium. The spread compresses. It becomes less headline-worthy, and people will declare victory. But even in the good scenario, you don't get a straight line. You get whipsaw, you get fake-outs, you get rumor spikes. Because when a market has just been stressed, it stays jumpy for a while. The volatility lingers. That's the point. Even if the thesis is right, price can whip around violently. And that's why you need levels and invalidations, not vibes. Scenario 2, the continuation squeeze. The bottleneck persists. Approvals remain slow. Imports face delays. People keep chasing dollars, just in case. Merchants keep repricing. Liquidity in the street thins because fewer players want to be short dollars into uncertainty. In that scenario, every attempt to pull back gets bought quickly, and the parallel rate prints new highs in bursts. It's not a smooth climb, it's a stair step. Spike, pause, spike. And the danger in scenario 2 is gap risk over weekends or thin liquidity windows, because the parallel market is not a deep, perfectly transparent exchange. When liquidity is thin, small imbalances make big moves. And that's where the market will try to emotionally manipulate you. So what are the levels that matter? Not because you're going to trade them like a day trader, but because they tell you which scenario you're in. If the parallel rate was recently around 148 from 500 per $100, and it can toss and hold above that area, if it spikes above and then fails and returns quickly below the mid-140s, that S consistent with speculative heat cooling and the controlled retest scenario. If it holds elevated, consolidates, and then breaks higher again with little relief, that tells you forced demand is still dominant and the bottleneck hasn't cleared. On the downside, watch whether the street rate can reclaim the low 140s and then sustain it. If it can, you're likely moving toward compression. If it can't, and every dip to that area gets bought aggressively, the squeeze case is alive, and that's not the part that matters. The part that matters is what would actually confirm that the plumbing is unclogging. Confirmation is not a politician saying, we're handling it. Confirmation is mechanics. Does the gap stop widening on bad news? Do merchants stop repricing daily? Do reports of delays fade? Do exchange shop spreads tighten? Do people stop talking about dollar scarcity and start talking about normal business again? Another confirmation signal is when the parallel rate becomes less sensitive to rumors. Rumor sensitivity is a sign of fragile confidence. When a market can absorb rumors without spiking, confidence is rebuilding. That's a real signal. And on the flip side, what weakens or invalidates the "this will compress soon" thesis? Sustained acceleration. If the street rate keeps making higher highs and higher lows while the official stays fixed, and if on the ground symptoms intensify, availability issues, rapid repricing, more chatter about cash dollars, then the friction is persistent, not transitory. And if that happens, the risk shifts from temporary dislocation to policy credibility challenge. That's a different beast. Now, let's talk about the mechanism in a way that's impossible to ignore, because this is where the finance-minded people get their edge. In markets, the most important question is always, who is forced to do what and when? In this setup, the forced actors are importers, merchants, and households hedging uncertainty. The when was pulled forward by policy and system changes and amplified by the calendar turn. The official channel is supposed to meet that demand in an orderly way. If it can't, because of compliance gating, processing delays, risk controls, or new procedural requirements, then the parallel market becomes the pressure release valve. And pressure release valves don't open gently, they pop. This is why you should stop thinking of the parallel market as some separate universe and start thinking of it like the options market in equities. Options tell you what the market is paying for protection and leverage. The parallel market tells you what the economy is paying for immediate settlement and certainty. In both cases, the premium is the price of immediacy under risk. And when that premium rises quickly, it tells you participants are losing patience. But that's not the only layer. There's also positioning, even if it's informal. Positioning here isn't hedge funds. It's the positioning of businesses and households. Merchants position short dollars because they assumed stable conversion. Households position long dinars because they earn dinars and spend dinars. When a spread widens, those positions become uncomfortable. Merchants rush to cover their short by buying dollars earlier. Households rush to cover by shifting savings. That's effectively short covering behavior. It's margin pressure without a brokerage account. The margin call is replacement cost fear. And replacement cost fear makes people buy at bad prices just to stop the pain. That's how moves extend. And that's why a parallel spread widening can run longer than observers expect. Because it's not just one trade. It's an ecosystem of forced adjustments. And that's where the real pressure starts. Now, the question everyone asks next is, so is the Dinar collapsing? Slow down. That's exactly the emotional trap. A widening parallel premium is a warning light, not an instant verdict. The official rate can remain stable for a long time while the parallel market whipsaws, especially if the central bank is determined to defend the anchor and the system ultimately adapts. But the existence and behavior of the spread matters because it tells you about confidence, about friction, about the real economy's access to hard currency, and about inflation pressures that may not show up in official narratives right away. It also tells you what policymakers will be forced to do next. Either unclog the channel, loosen certain constraints, increase official dollar availability, accelerate processing, or intensify enforcement to suppress the parallel market. Any of those actions can change the spread quickly, and that's why the next week or two are about watchfulness, not certainty. Here's the psychological shield you need, because this is where smart retail viewers get wrecked even when their analysis is correct. Volatility is a weapon. In thin markets, it's used to shake out weak hands, to trigger panic buying, and to create the feeling that you're late. The spread will widen on bad rumors, then compress on a quiet day, then widen again on a weekend gap. And if you're emotionally attached to every tick, you'll make the worst decisions at the worst time. The trick is to separate trend signal from noise. Trend signal is the behavior of the premium over multiple sessions and its relationship to real economy constraints. Noise is the intraday spike driven by chatter. A simple rule: if the spread widens but then immediately snaps back and holds lower, that's often noise. If the spread widens, stays wide, and starts pulling prices and behavior with it, merchant repricing, dollar hoarding, liquidity thinning, that's signal. And you don't need perfect data to feel that difference. You need discipline. Because if this one level breaks, the math changes. Now, let's turn the lens toward what comes next, because that's what you're here for. Over the next week or two, the key drivers are not abstract. They're operational and political. Watch for signs of faster official settlement and approvals. Watch for any adjustments to how duties are paid and when. Watch for credible efforts to make import financing smoother, because that directly reduces forced parallel demand. Watch the rhetoric, yes, but more importantly, watch what merchants do. Merchants are the front line. If they stop repricing aggressively, that's compression. If they keep repricing and shortages start being whispered about, that's pressure. Also watch weekends. Thin liquidity periods matter. Moves that happen into weekends can gap because there aren't enough sellers or buyers to balance. And when gaps happen, they feed narrative, and narrative feeds demand. That's the reflexivity loop again. Let's get even more practical. If you're tracking this like a macro watcher, your checklist is 4 items. 1, does the premium stabilize or keep ratcheting? 2, does the market's sensitivity to rumors decrease or increase? 3, do reports of delays and bottlenecks fade or intensify? 4, do people's behaviors change? Are they still rushing into dollars, or do they start acting normal? If you see stabilization plus reduced rumor sensitivity plus fewer bottleneck anecdotes plus calmer consumer behavior, you're likely in scenario 1. the controlled retest. If you see continuing premium expansion, high rumor sensitivity, more bottleneck chatter, and increasingly defensive behavior, scenario 2 is alive. And in scenario 2, the risk is not just price. The risk is the social and inflation pressure that forces policy responses. Those responses can be abrupt. They can be heavy-handed. They can create short-term compression that looks like victory but isn't durable. That's why you don't worship one day's move. You watch the sequence. And here is an uncomfortable truth. Policymakers have incentives to talk down the parallel market and to emphasize the official anchor. That's not inherently malicious. It's risk management. Managing expectations is part of central banking. But markets don't care about intent. They care about outcomes. If expectations are managed but the operational bottleneck remains, the premium will keep doing what it does. And if the premium keeps widening, the narrative loses power. Then the only tools left are mechanical. Supply more official dollars, streamline access, or crackdown. Each tool has trade-offs. More supply can ease premiums but raises other concerns. Streamlining can work but requires competent execution. Crackdowns can suppress the symptom temporarily but often increase anxiety, which paradoxically increases hoarding. And that's where the real pressure starts. So if you're a skeptic of institutions, don't turn that skepticism into a fantasy. Turn it into a framework. Institutions respond to incentives. Right now, the incentive is to defend credibility without triggering more demand. That means they'll likely try to compress the spread while keeping the official rate stable. They'll do it through channel management, compliance adjustments, and messaging. Your job as a viewer is to watch whether those actions actually change access and timing, because access and timing are the hidden levers behind the spread. Now, let me address the metals and commodities crowd directly, because you're used to thinking in terms of physical bottlenecks and paper pricing. This is the same movie, different actors. When the system S deliverable currency, the kind you can actually use to clear goods, becomes scarce or delayed, you get a premium. That premium is basically the basis. In commodities, basis blows out when local demand meets logistical constraints. In FX under constraints, the parallel premium blows out when local demand meets settlement constraints. Same mechanism. And once you see it that way, you stop arguing about morality and start watching structure. And structure is what lets you anticipate the next phase. The next phase is not guaranteed. Nothing is. And anyone promising you guaranteed outcomes in a setup like this is either selling you something or coping. The honest view is, even if the thesis of mechanical demand spike due to new procedures and calendar timing is correct, the price can whip violently. You can get a sharp compression move that makes people declare the problem solved, and then another widening move if a new rumor hits or if execution falters. That's why your two-scenario lens matters. It keeps you from getting emotionally hijacked. So here is the subtle but important community message. You don't need to be the first person screaming collapse or nothing to see. You need to be the person calmly tracking mechanics while everyone else chases narratives. That's the difference between being informed and being reactive. And the people who win in macro, whether they're trading, allocating, or just protecting purchasing power, are the ones who can hold a framework through noise. Let us tie it all together in one clean chain so you can replay it in your head. The spread widened quickly, which signals stress. Though why now is the calendar turn plus procedural and compliance friction hitting at the same time, which pulled demand forward. The hidden detail is the upfront payment and clearance mechanics that create immediate cash dollar demand. The market structure explains why the gap doesn't point instantly arbitrage away. Access and settlement constraints block alignment. The proof stack is not one data point. It's street behavior, cash flow timing like salaries, government efforts to compress the spread, the stock versus flow trap in reserves, and the budget anchor that makes spread widening a credibility issue. The behavioral dynamic is reflexive. Widening premium changes pricing behavior, which changes demand, which widens premium. The psychology shield is to separate trend signal from rumor noise and to expect violent whipsaws even if you buy once we're right. The what comes next is two scenarios. Controlled retest if the system adapts, or continuation squeeze if the bottleneck persists. And your checklist is constraints, not speeches. Because if this one level breaks, the math changes. Now, if you want something concrete to hold on to, here it is. Watch whether the street rate can stop printing higher highs above the recent area near 148,500 per $100. If it can hold above that zone and it starts drifting back below the mid-140s with calmer behavior, that's the compression story gaining traction. If it holds elevated and keeps stair-stepping higher, that's the squeeze story. On the support side, if you see a pullback toward the low 140s and it stabilizes there, that's a sign the market is digesting and the forced demand is easing. If you see a pullback and it gets instantly bought, snapping back higher, that's a sign forced demand is still dominant and liquidity is thin. Those are not trading signals. Those are regime signals. They tell you whether you're in a stabilization regime or a stress regime. And once you know the regime, you stop getting tricked by every headline. And here is the last open loop I promised to close. What would actually have to happen for the spread to meaningfully compress, not just for a day, but for weeks? 1, the official channel has to be faster and more reliable in delivering dollars to legitimate import needs. 2, the procedural bottlenecks, especially around customs timing and prepayments, have to stop pulling demand forward into panic windows. 3, public confidence has to stop being rumor-driven, which usually happens only when people experience normalcy for long enough that they stop hedging reflexively. If you get those 3, the spread compresses. If you don't, the spread stays volatile and elevated, and the economy pays the premium through higher prices and lower trust. That's the real cost, not the chart. The cost is the premium becoming embedded. So here's my ask, and it's not a begging CTA, it's an identity check. If you are the kind of person who refuses to be hypnotized by headline theater, and you actually want to track how markets work when the plumbing matters, stay close to this conversation. Because the crowd will keep debating the official rate like it's the whole world. The real signal will keep living in the spread, in the settlement friction, and in the calendar windows where liquidity thins. And that's where the real pressure starts.